Good morning, viewers. You're welcome to the Market Review. Today, Tuesday, December 15, 2020, where we look at developments in the fixed income and bonds market. We'll be looking ahead 2021, leveraging the debt market to finance infrastructure. Yes, it's the last month of the year 2020. Ayodeji, Senior Economist, Greenwich Merchant Bank. Good morning and nice to have you, Mr. Bo.
Good morning. Thanks for having me.
Yes, Mr. Bo. Quickly, let's take on some developing stories. First, Moody's dropping its report, Nigeria, saying that Nigeria had a B2 negative credit profile, and it says it reflects the country's increasing exposure to fiscal and external shocks because of its very weak government finances, which are constrained by an extremely narrow revenue base that hinders fiscal consolidation. Moody's said this in its report that was released. It also says that after this year's economic contraction, Nigeria's deficit will remain high and debt levels will continue to rise quickly, albeit from a moderate level. That's Orion Mali, the vice president of the service, senior credit officer and the report's co-author. Another quote from that report shows that the country's weak institutions and governance framework also constrain the credit profile and have significantly affected both economic and government's fiscal strength. I want to tie this to a quote credited to you, Mr. Ayodeji, several months ago by one of the national dailies, that if COVID continued in its heat, Nigeria will feel the effects in over 6 months. What is your thought on the Moody's report, and does it corroborate what you earlier warned about as we look at the market and the debt market too?
So the Moody's report, what Moody has highlighted, it's nothing very new. When you look at our revenue sources, it is skewed towards oil. The government is always optimistic. We plan with less dependence on oil. But when you check the actual performance, year on year, you would see that more of the revenue, over 50 to 60%, have always come from oil. And the worrisome part is that when you also compare our debt service as a proportion of the total actual revenue, not budgeted revenue now, you will discover that it's over 60 to 70% of that we 60 to 70% of the total revenue that is being used to service debt, which now highlights or corroborates what Moody is saying, that our debt level will remain very high. So we have been borrowing a lot to support or to finance other non-debt expenditure, which are non-productive. You don't expect to generate any income from them to repay back those debts. So it's really a trying time. And even with the challenging period, when you look at the 2021 budget, has been projected to about 13 trillion naira, and we're expecting 13 trillion naira, and we're expecting we're projecting a revenue of about 7 to 8 trillion naira. You would see that the gap is about 5 trillion. But when you look at past performance, you discover that even based on what the government has achieved so far as at July, they've only been able to realize about 2 trillion, 2.1 trillion. If you analyze that and also factor in the impact of COVID, let's even assume they were being very optimistic, they are able to hit 5 trillion. You will still see that the gap of about 2 trillion relative to what has been projected for next year. So that leaves, when you look at debt servicing, about 3 trillion. So if we're projecting actual of 5 trillion and debt service is about 3 trillion, when you look at that, you see that it's really very high. But beyond that, the major sector or the major driver that should help boost revenue for us to be able to generate significant revenue to repay. We're not focused on that. We look at the foreign trade data that was published yesterday by the published last week rather by the National Bureau of Statistics. You would discover that manufacturing sector is still less than 10%. So we depend a lot on oil for FX earnings. We depend a lot on oil for the Naira revenue of our fundings. So any major distortion would affect and destabilize whatever projection that the government has in mind. So now there needs to be deliberate effort to shift, even if we have to borrow, to develop those productive sectors, manufacturing, trading, ICT. If we look at those agri, those 5 sectors account for over 80% of the GDP. So let's focus on the oil. And if we have to develop oil, we should sign the PIB into law so that it can attract investment, and the government does not need to use the resources to develop it.
Okay, that's very, very clear.
If we borrow, we have to borrow to develop productive sectors, and just like you said, the signaling of PIB signing would help to attract more investments, reduce government's activity in that regard. But let's look at the International Monetary Fund just today disbursing about $1.2 billion to Nigeria. How does that come at this point when Nigeria needs to show up a lot in terms of financing to meet some of its obligations and other demands as we reel out from this recession?
Okay, thanks. It's a positive development for Nigeria to get the approval from the World Bank, about $1.5 billion. And that would help shore up our external reserves, as at yesterday was around $34.9 billion. So if we look at the average 60 days, within the next 60 days, it should average over 36 billion dollars. One, it gives some form of comfort to the CBN, and they can increase the capacity of their interventions and also reduce some of the capital controls, so that it will provide sufficient leeway for them to be able to increase supply. We also, if we make reference to the diaspora funding that diaspora policy, FX policy that was introduced about 2 weeks ago, that is also expected in the short to medium time, is also expected to also increase liquidity to the parallel market. And I think it's positive for Nigeria. And we also note that oil price is also approaching $50. Brent crude is around $50 per barrel. So as we progress, I think for the CBN, yes, I think for the CBN, they'll begin to take some form of, it will be a major relief for them, and they can begin to work on how confidence can be restored into the FX market and how we may begin to attract more FDIs and FDI, and we see more clarity around it.
Okay, that's also very
clear from what you've said. I'd like us to take a look at the developments around the Nigerian Governors Forum consideration to tap into the pension market, to borrow funds, to finance infrastructure and other critical issues as socioeconomic. Like you rightly said, if we're going to borrow for productive sectors. Over the years, subnationals have been on the limelight in terms of being able to show fiscal governance, even for what they borrowed in the past. Do you think this is the right step, and do you think it's also a good deal to go to the pension route for subnationals?
I would like to provide some clarification around this news, around the governors trying to access the PFA funds. Firstly, the total pension asset is about, as at August, based on the numbers on the PENCOM website, is at 11.6 trillion naira. Governors projecting 17 trillion also shows that there's a mismatch in or a mix-up in the figures. Secondly, about 66% of the total assets of the PFAs are being held by the federal government. So if the state government will need to access these funds, it means that the federal government needs to pay back the 66% of the 11 trillion, which is about 7 trillion. So I believe that it's, I think there's a communication gap within that space, and there's no way the governors can access a fund that has already been borrowed by someone, by the federal government. And it's even the numbers is also out of whack. So, but to also focus on the other part of your question, the state government have been trying to see how they raise funding to support, and we've seen a lot of states within the last 2 months raise funds to support the infrastructure. So I believe that if we're able to, if these funds are channeled to for infrastructure, it would also help develop and open up the economies within the, it will open up those economies within the, within those states. I believe what we also need to be, most states needs to work on, we need to begin to see some regional collaboration. So yes, federal government have been able to provide rail from Lagos to Ibadan, but this could have been done by the states rather than waiting for the federal government, and can be done through a public-private partnership. So they need to look at more collaboration if it's going to be a light rail that the state within a particular region from Lagos, Ibadan, Oyo, Osun, Ondo, and that would increase the activity within those regions. If you look at also the Southeast, they should look for the infrastructure that pulls them together. So those states should also now identify what are those major resources that they can add value to. We know even in Osun State, they discovered gold in commercial quantity. Are they able, how are we able to refine it? How are we able to add value, not just exporting the gold? So if we add value, that would develop our manufacturing sector. So across the state, you go to the northern states, those cash crops, can we be strategic by adding value? Can government begin to subsidize production and not subsidizing consumption, so that we can increase our manufacturing capacity and we can generate more jobs? And that would also diversify the FX inflow that will all be depending on oil. So I think by and large, it's not a bad thing for the states to borrow, but it's also important to borrow to finance projects that are economical. And most of these funds that is being borrowed, the states should not, for most of the larger part of this project, should not solely fund some of those projects. They can use those funds as equity contribution, which increases the multiplier effect. So by what I'm saying, to put it into perspective, if I'm able to raise 5 billion, some of the projects, it means that 5 billion, I may be able to fund project worth 20, 30 billion as equity. And that project can still be achieved within a short period, and it would repay itself back. So it can be done on a build, operate, and transfer after some years. And that would really help open up our economy, increase and generate employment, and reduce insecurity.
Yeah, that's very good.
Clear. We need to subsidize production, not consumption, and strengthen those PPP models of build, operate, transfer, so we can make some very key leeways. Now let's look at 2021. What are the headroom and opportunities in the debt market to accommodate federal government and states? Because like you've seen what Moody said and what you've said earlier, like 6-7 months ago, Nigeria will be facing those revenue challenges. So federal government, states will need to find creative ways to finance deficits, if it's the infrastructure and other very critical investments that needs to be made to unlock the economy.
Yeah, so I think I touched on one of the areas or the structure government can look at. Government needs to admit that the resources are limited and it's continuing to be pressured. So how can the government maximize the little resources? The main structure that can be done is to use those resources as equity contribution. Most
As
of
government
the
assets, government assets?
No, I mean that government needs to use the resources, the few resources as equity contribution in a lot of these projects.
Okay.
In a lot of these projects, the Niger bridge has been on for how many years now? Government trying to fund it. We need to. You see, Lagos Ibadan is close to 10 years. We've been allocating on a yearly basis
different contracts,
to fund the construction of that road. If we look at the productivity of that road, if that road can be completed in 1 or 2 years, it can generate back the money within the next 10 years. You'll be sure commuters will be happy to pay. And when the road when they'll be able to save time, if it would take less than an hour or an hour to get to Lagos to Ibadan, and economic activity can move. They can move goods from Lagos to Ibadan or move goods from Lagos to other regions of the country. So I believe that the government just needs to intensify efforts. I know the Bureau of Public Enterprises are also trying to see how they want to concession some of these roads. Also this policy on using tax credits, your 50%, maximum of 50% of your tax credits to build the road should also be encouraged. Dangote has taken that first move advantage. Flour mills have also been assigned the road. So we need to see more, especially even the banks. When you look at the tax they pay, it's also significant. So they should also identify some of these critical roads and take it over. And we know within the next 1 or 2 years, resources will be deployed into those infrastructure, and we can jumpstart the economy to a more sustainable growth rate, and will reduce insecurity, which was also highlighted by Moody's, which was highlighted in the Moody's report.
Definitely. Now let's look at the fixed income and bonds market in 2021. What for you is the outlook? What would be the key things that will shape that market, which continues to be a key player? I know that debt, of course, we won't be surprised. Like this year, we've seen some states, Lagos, Edo, and others, look at mulling, issuing various bonds. Are you going to see much of that happen next year? What will shape the activities in the market?
Yeah, I think that the first thing is that it will maybe difficult for some of the states to increase their exposure to borrow more in 2021. The DMO, the SEC, they are also trying to look at how not to overexpose states to a lot of borrowings. So in parts of some of the major factors that will shape maybe yields, the yield environment, we know government will be borrowing over 4 trillion, and the government will need to front load those borrowings. So we may see rates improving even in from the first quarter or maybe let's say second quarter of 2021. We also feel that once the CBN also see that the economy has moved to a positive trajectory, they may also want to begin to adopt a hawkish a hawkish stance where we'll begin to see rates increase so that to reduce money supply and pressure on inflation. But then lastly, the maturity we'll be expecting next year is not as significant as what we saw this year. So when you look at we look at on the balance of factors, we look at this, we'll discover that the rates has more potential to improve in 2021 compared to the trend we had in 2020.
Okay, so indeed, rates to improve, but maturities may not be like in 2020. And of course, it's going to be challenging for states to borrow more. What the federal government is doing is huge. And definitely, one area I'd like to touch on briefly is sustainable finance and green bonds. I mean, there's a lot of big thing around sustainable finance, renewable energy, clean energy. We need to value the climate. So we expect to see some activities in that area too.
Yes, I think if we look at the economic sustainability plan, the government already has a plan to see how they want to install install solar panels in about 5 million households, which we feel that is going to be very positive for the areas. The focus is more of the rural areas, and that would also help jumpstart business activity within those areas. And we feel that with the available green funds that is they're willing to support green initiative, we believe that government should be able to access these funds even from the international market once the structure is watertight and provides confidence. We believe that the funding should be accessible and should also be considerable with what government is projecting that for the household we paying about $4,000, 4,000 naira rather on a monthly basis. If we look at that vis-a-vis the new electricity tariff, that will still be very considerable. And you would also, for some of those economies, they were able to increase their business activity and reduce their costs of doing business in most of the rural areas where they have to use gen to run their businesses.
Well, so as we wrap up, looking at the year 2020 has been a very eventful year. What for you has been the key lessons in the fixed income and bonds markets from global to Nigeria?
Okay, interestingly, the 2020 has been an unpredictable year. A lot of ups and downs, and the COVID-19 pandemic has changed a lot of projection and forecast. But something interesting, or the learning point this year, is that the fixed income market can provide support for a lot of for businesses. So we've seen for the corporates that we've always been clamoring the crowding out impact or effect. The low interest rate environment has helped them to access the capital markets, and a lot of them have been able to refinance their existing loan at a cheaper rate, which we feel is positive. So that's what that says, is that we cannot, if we continue to keep interest rates very high and very attractive, the banks or even the private sector will not be able to access funding. For the banks, there will be no incentive for them to lend to customers if yields within the treasury bills market, for instance, around 11 and 12%, which is very high compared to the rate at which they would lend to customers. So I think we need a low yield environment for us to be able to grow the real sector. And we know the real sector is evolving, and over time we'll be able to, fund managers, financial advisors would learn from this current trend and build watertight structures that investors' funds will be protected, but ultimately will be able to grow the real sector.
Which is very important.
For the economy. So I want to thank you very much, Mr. Ayodeji, for the time. I mean, really interesting insights you've given us concerning the leveraging the debt market for infrastructure, very critical at this time in the country. And we hope to see a very interesting and much improved 2021, hoping that governments, both at federal and subnational, utilize the funds very well, borrow to support productive sectors, and like you rightly said, I like that part, subsidize production, not consumption. Thank you once again, Mr. Ayodeji, Senior Economist, Greenwich Merchant Bank, for the time.
Thank you for having me. Always my pleasure.
Thank you. Yeah. And that'll be all for today's edition of the Market Review. You can join us for further conversations on the Market Review as it affects the financial and the capital markets. Send us your views and thoughts around leveraging the debt markets to finance infrastructure. What do you think are creative ways the federal government and state governments can take the approach, even the private sector? And what are the things you think that will shape the fixed income and bonds market in 2021? Send your views and comments to news@prochang.com. We'll be glad to receive them and respond where required. Also, join our website, www.prochang.com. On that website, you click on the right-hand bar, you see fixed income and bonds market. We have it all covered for you, from activities of the FMD exchange down to all the players and even our partner analyst groups who have stories and insights on what's happening in that space. To come your way again, thank you for watching. Have a nice day and stay safe.